Hello everyone, we will be starting our first reading of derivatives. So the first reading is derivative instrument and derivative market features. So basically under derivatives, we will be going through uh, the whatever types of derivatives are, how do you price derivatives. So this first reading is basically the introduction of what do we mean by derivatives. So derivative is what? Derivative is a security which derives its value from an underlying instrument. So derivative is a security whose value is dependent on some underlying instrument. So it's a security whose standalone doesn't have any value. Like I say, I have a call option, I have a put option, or I have a forward rate agreement, or I have a futures. So when I am mentioning all these types of instruments, I need to mention that on what security is my instrument based on. Like if I have a call option, on which stock price I have bought my call option, or if I have a forward rate agreement, what is the commodity I'm trading in. So the underlying instrument can be anything. It can be your any stock, any indices, any commodities. Like you can trade in interest rate agreements. If you are a person who will be getting, let's say, interest dependent upon what the MIBOR rates are. So if your interest depends upon what MIBOR rates are, so you don't know what your interest amount would be. It would be fluctuating. So you have a floating interest rate payment. But you are not comfortable with floating interest payment. You want the surety about how much amount of money you'll be receiving. So maybe you can trade your interest payments with a person who would be agreeing to pay you fixed rate of interest payment. So we called it swapping. You are swapping interest rates. You would be giving them payments in floating interest rate, and they would be giving you payments in fixed interest rate. Basically you would be deciding upon an interest rate that okay, this is the fixed amount I would be paying you. So the underlying instrument can be anything. It can be stock, it can be indices, it can be commodities. And a derivative is a security which standalone doesn't have any value. It derives its value from the underlying instrument. After this, the first kind of derivative is forward contract. What is the meaning of forward contract? Under forward contract, we decide today that in future we would be exchanging certain commodity, a specific commodity, at what price. So under forward contract, there would be a buyer of the forward contract and there would be a seller of the forward contract. Now, these two people, they will be deciding today at what price after certain time in future they would be exchanging these commodities. Like, let's say, taking the example of McDonald's. Now, for McDonald's, what is the important ingredient for McDonald's? Potato. McDonald's need potato for everything, for producing everything. This is like the uh, Most important ingredient. Now, McDonald's know that after 6 months, I would be needing 1,000 kgs of potatoes. These 1,000 kgs of potatoes I would be needing after 6 months, because I want to distribute 1,000 kgs of potatoes to my franchisees in India. So McDonald's have calculated this, that after 6 months I require 1,000 kgs of potatoes. Now, since they require 1,000 kgs of potatoes, it would be a huge cost for them. So they don't now they the analysts of McDonald's want to present what the revenue cost analysis would be after 6 months. Now, for this, the analyst needs to be sure that at what price would my 1,000 kgs of potatoes I would be able to buy. Now, McDonald's want that surety, that let's say today the price of the potato is rupees 20 per kg. Now, after 6 months, McDonald's don't know whether it would be 25 rupees per kg or rupees 18 per kg. Like, it can either increase or decrease. They are not sure about it, but they don't want this risk. They don't want this uncertainty kind of situation here. So what they do, they would be getting into an agreement with a farmer. Now, again, for a farmer knows that basically after 6 months I would be able to harvest certain kgs of potatoes. Now, farmer wants to plan out whatever his farmer wants to plan out his expenses for the 6 months. Now, for planning out the expenses for the 6 months, farmer would want to know today at what price farmer would be able to sell these potatoes after 6 months. The farmer also want the uncertainty element to be removed from the situation. So McDonald's and farmer can come into a contract that after 6 months, farmer would probably say to McDonald's that after 6 months, I'm ready to sell you the potatoes at rupees 22 kgs. Today, the price of the potatoes are 20, but after 6 months, I'm ready to sell you 1,000 kgs of potatoes at rupees 22. Now, if McDonald's agree to it, they would enter into a forward contract wherein they have decided today that at price rupees 22, they would be buying, exchanging certain commodities in the future, that is after 6 months. Now, after 6 months, what can happen? They have logged in the price today at rupees 22. So after 6 months, the price of the potatoes can, let's say, have either increased to 25 or decreased to 18. If the price of potatoes have increased to rupees 25 per kg, who would be benefiting? Now, farmer in McDonald's, farmer would have to sell 1,000 kgs of potatoes to McDonald's at rupees 22. If farmer had not agreed into this agreement, farmer would have been able to sell the potatoes at rupees 25 instead of 22. So if now the market price, whatever the price is in the market, it is greater than the price they have agreed to, it is greater than the forward price. So whenever the commodities price increases, who benefits? Buyer of the forward contract benefits. Here McDonald's have benefited, because if after 6 months McDonald's have gone into the market and bought potatoes, they would have to buy the potatoes at rupees 25. But because of the contract which they have agreed with the farmer, because of the contract between them, they were able to buy the potatoes at rupees 22. So after 6 months, who has benefited? The buyer of the forward contract are McDonald's. If after 6 months the price of the potatoes falls to rupees 18, McDonald's would have been able to buy the potatoes at rupees 18 if this contract would not have existed. But because of this contract, they would have to buy the potatoes at rupees 22 instead of 18. And farmer benefits. Why? Because farmer has the opportunity to sell the potatoes at rupees 22 when the current market price is rupees 18. So when the current market price is less than the forward price, who benefits? Seller of the forward contract benefits. So what is our underlying instrument here? Our underlying instrument or our underlying asset is the potatoes. The forward contract is based on the potatoes. What is the forward price? Forward price is the price at which they have agreed to exchange the commodity after 6 months. Our forward price is rupees 22. What is the settlement date? Settlement date is the date they would have decided that okay, after 6 months we would be exchanging these commodities. So today it's 28th February. So after 6 months, let's say they have decided that their settlement date would be 28th August 2026. What is the contract size of the forward contract? What is the size of our contract? Our size of the contract is 1000 kgs. Now this forward price, it is calculated in a way that at the initiation of the contract, the value of this forward contract is zero for the both the parties. The forward price is such price that when the contract has been initiated at the start of the contract, the value of this forward contract, that after 6 months they would be exchanging potatoes to both the parties, to McDonald's and the farmer, would be zero. So value of the forward contract at initiation is zero. So value and price are different, two different things. So don't get confused between what is the value of the forward contract and what is the price of the forward contract. Coming to another term, spot price. Spot price is nothing but what is the price at the moment. At that moment itself, what is the price? So what is the price today? Today, if I'm talking about the potatoes, the price was rupees 20 kgs. Now after 6 months, the price, like we decided, it can be 25 or 18. So the spot price after 6 months can be rupees 25 or can be rupees 18. So if the spot price is greater than the forward contract price, then the forward price, then who benefits? The buyer of the contract benefits, McDonald's benefits. And if the spot price is less than the forward price, then the seller of the contract benefits. So buyer of the forward contract will always benefit when the price of the underlying instrument increases. When the price of the instrument increases, because the spot price is increased from rupees 20 to 25, so the buyer of the contract benefits, and the seller of the contract will benefit when the price of the forward contract decreases. So buyer of the forward contract benefits when the price increases. So buyer of the forward contract is long for that asset. The buyer of the forward contract here is long in the potatoes, has a long position in the potatoes. For the seller of the forward contract has a short position. That is the benefit if the price of the underlying instrument falls. The forward contract can be deliverable contract, that is physically settled, or it can be cash settled. That is, in our case, our contract is physically settled. After 6 months, McDonald's and farmer would actually be exchanging potatoes. So, if two parties have entered into an agreement where after the time has passed, that at the settlement date, they are actually exchanging the underlying instrument. If they have entered into a contract that after 6 months, I would be selling you this stock, and you would be buying, and I would be buying this stock from you. So, after 6 months, if this exchange of that stock actually happens, it is called physically settled contract. What is cash settled contract? That is, if two parties have entered into an agreement that after 6 months, one party has agreed that I would be buying this stock from you at rupees 50. The current price of the stock at moment is rupees 40. But after 6 months, if the price of the stock rises to rupees 60, the buyer of the who is benefiting if the price rises to rupees 60? The buyer of the forward contract, because if the price of the underlying instrument, the buyer of the forward contract increases, the buyer of the forward contract benefits. So here, what is the difference? The price in the market is rupees 60. They have agreed that they would be exchanging the stock at rupees 50. So the seller would have to buy the stock from the market at rupees 60 and sell the same stock to the buyer of the forward contract at rupees 50. So there would be a rupees 10 difference. So in the case of cash settled contract, they do not exchange the commodities. What the seller would do, that okay, I would have to buy the, if I were to go into the market and buy the stock, I would have to pay rupees 60 in order to buy the stock, and I would have to sell the same stock to you at rupees 50. So I would be making a net loss of rupees 10. And if now, in the case of the buyer would be able to buy the stock at rupees 50 from the seller of the forward contract and would be able to sell the same stock at rupees 60 into the market. So the buyer is making a profit of rupees 10. So they just exchange the cash amount difference and not actually the exchange of the stock or the underlying instrument. If the price falls to rupees 30, where they have agreed to exchange the stock at rupees 50. So here, what is the difference? The difference is rupees 20. The buyer of the forward contract would have been able to buy the stock from the market at rupees 30, but because of the forward contract, the buyer has to buy the stock at rupees 50. So the buyer pay the differential amount to the seller of the forward contract. So they, in the cash settled kind of derivative contract, the underlying instrument is not exchanged, just the differential in the cash amount is exchanged. So there can be two reasons why we are entering into a forward contract. You can enter into a forward contract for hedging your risk, or you may have entered into a forward contract just for speculation reason. That is, here our farmer and McDonald's have entered into a forward contract because they wanted to hedge their risk of whatever price they have to bear in the future. McDonald's wanted to lock in the price at which they would have to buy potatoes after 6 months, and farmer wanted to lock in the price for which they have to sell potatoes after 6 months. So they wanted to hedge their risk. So you can enter into a forward contract for hedging their risk. This hedging can be fully hedged contract, or it can be partially hedged contract. Partially hedged means that after entering into the forward contract, your whole risk has not been hedged. Some part of risk still lies with you. Now here, what if I want to, let's say, what did the farmer wanted to do? The farmer wanted to sell potatoes in the future. How would I decide that? Would, if just for remembrance, how would I decide that who would be buying the forward contract and who would be selling the forward contract? The farmer wanted to sell the potatoes in the future. So whatever you want to do in the future, you want to sell the potatoes in the future, the same thing you do in the forward market. If you want to sell potatoes in the future, you sell forward contract today. And in the case of McDonald's, they wanted to buy potatoes in the future. So they would be buying forward contract today. Or you may have entered into the contract only for the reason of speculation. Like considering this situation, let's say their bread and butter is not dependent on this stock. They have just entered into the contract because of speculation reason. One person believes that the price of the stock would be increasing, the other believes that it would be falling. So they have agreed at the rate of rupees 50. One person is of the view, the seller is of the view that the price of the contract would be falling. So I would be able to buy the stock at lesser price, and I would have to, I would have the opportunity to sell this stock to this person at a greater price. Now, the buyer of the forward contract is of the belief that after 6 months, the price of the stock would be increasing. So, I would be benefiting from the differential. So, this kind of arrangement can be called speculation, wherein we are not hedging any risk. I'm not hedging any risk, but I'm just betting on what the price would be in the future. And if my speculation or if my prediction goes in the correct way, so I would be making some money out of it. So this is what is speculation and hedging. As we discussed, underlying assets can be anything. Your underlying instrument in which you are entering into the forward contract, it can be anything. It can be a bond. We will be discussing in detail what bond is in fixed instruments. So you can enter into a forwarded agreement with a person that, okay, after 20 years, after 10 years, I would be buying this bond from you at so and so price. This is the price I would want to lock the buying of the bond. So after 10 years, I would be purchasing from this bond from you. So you basically store this, keep this bond in your inventory for me for 10 years. You can be trading in index, just which we have discussed. Basically, you can be trading in index. You can be trading in currencies. Like, let's say I have a certain pound. I've been into business with a firm, and that firm would be paying me certain amount in pound. Okay, but I want to be sure, because the exchange rates, I'm not sure how the exchange rates would be functioning after 1 year. I'm not sure about it, what the exchange rate would be, but I want to be sure about what price in pound, basically whatever amount. I'm sure that I would be getting 50,000 pounds, let's say I am sure that I would be getting this amount after 1 year. But this amount I'm sure, but after conversion to INR, what the amount would be, I'm not sure. So I want to lock in this price today. So we can enter into a currency agreement that, okay, I would be paying you 50,000 pound in the future. You, after 1 year, you tell me right now that what amount in INR you would be paying in the future to me after 1 month to me. So your currency can also be the underlying instruments. Commodities can be underlying instrument, like we decided. Commodities can be hard commodities or soft commodities. We have discussed the case of McDonald's and Farmer. So that was a case of commodities. Soft commodities can be what? It can be cotton, coffee. Hard commodities can be crop, metals, that is gold, silver. After this, the underlying instrument can be credit derivatives, credit default swaps. That is, you have entered, there's a person B, and there's a person A and there's a person B. Person A and B has entered into a credit default swap. Person B would keep paying certain amount to person A after every 6 months. And if by chance, whatever the period of the contract they would have agreed, if in that period person B becomes bankrupt, person B goes bankrupt, so person A would be helping person B in this case. So person B would keep on paying person A certain amount after every 6 months, and if in the whole tenure of the contract person B defaults or goes bankrupt, person A would be helping person B. So this is what credit default swaps arrangement looks like. After this, we can trade into weather, cryptocurrencies, and so on. So the underlying instrument can be anything. Now, coming to exchange traded derivatives and over the counter derivatives. Forward rate agreement is an over the counter derivative. Like two persons, they come together, they decide that, okay, after certain time in the future, we would be exchanging these commodities at this price. So whatever agreement they make, it is customized to their requirements. They do not have to basically submit any sort of security or any collateral that, okay, if the other person defaults, so I would want collateral in that case. So you submit any margin to some person. So there is no regulatory body in between them. If there is no regulatory body in between them, it is risky. They would be facing counterparty risk. If person A defaults in their agreement after 6 months, so person B would be facing counterparty risk. In case of exchange traded derivatives, there is a central clearing house party. The central clearing party stands between the buyer and the seller of the forward contract. This CCP would be asking the buyer and the seller of the forward contract to submit some margin. Exchange traded derivatives are also called futures. Futures are exchange traded derivatives, and forward rate agreements are over the counter derivatives. The meaning of forward rate agreement and the futures are exactly the same, that you decide today after 6 months what at what price you would be exchanging the commodities. But in case of futures, you have a party in between, regulatory body in between, who would be monitoring your activities. But in forward rate agreement, that is not the case. So futures are not customized. You would have to trade into specific lot sizes. Okay, you can't say that I am comfortable with only buying 400 units of the stock after 6 months review. If the lot size has been fixed at 500, that you have to trade in at 500, you would have to trade in at 500 only. It can be customized as in forward rate agreement, but here, since there's a central clearing party in between, so the counterparty risk is removed. You do not have to worry that okay, after 6 months, what if my counterparty fails or goes bankrupt, then my contract would not be fulfilled. So that isn't the case here. There's a regulatory body protecting your interests. After this, under futures, there would be certain trading costs and everything because of the exchange involved in between. So that is the difference between forward rate agreement and futures, or that is the difference between exchange traded derivatives and over the counter contracts. So this is it for today's class or today's lecture.